Quantitative tightening, or QT, is a monetary policy tool used by central banks, including the Federal Reserve, to reduce the amount of liquidity or money supply within the economy. It is essentially the opposite of quantitative easing, or QE. While QE involves purchasing financial assets to inject money into the economy, QT involves reducing the central bank's balance sheet by either selling assets or allowing them to mature without reinvestment. Here's a detailed explanation of QT and its effects on the stock market. How quantitative tightening works. First, let's talk about reducing the balance sheet. The Fed holds a large portfolio of assets, primarily U.S. Treasury securities and mortgage-backed securities, or MBS. During QT, the Fed allows these securities to mature without reinvesting the principal payments into new securities. Alternatively, the Fed can actively sell securities from its portfolio, though this approach is used less frequently due to its potential to disrupt financial markets. Next, we have decreasing bank reserves. As the Fed reduces its holdings, the amount of reserves in the banking system decreases. Banks have fewer excess reserves, which can lead to tighter lending conditions. Reduced liquidity can put upward pressure on interest rates, both short-term and long-term, as there is less money available for lending and investment. Objectives of quantitative tightening. One key objective is the normalization of monetary policy. After periods of expansionary policy, like QE, the Fed uses QT to normalize its balance sheet and monetary policy stance. Another objective is to control inflation. By reducing the money supply, QT aims to prevent the economy from overheating and keep inflation in check. Lastly, QT can help mitigate risks associated with excessive liquidity, such as asset bubbles in stocks, real estate, or other markets. Effects of QT on the stock market. Quantitative tightening can have significant impacts on the stock market due to changes in liquidity, interest rates, and investor sentiment. First, reduced liquidity and increased volatility. As the Fed withdraws liquidity, there's less money available for investors to put into stocks and other financial assets. This can lead to decreased demand for equities, putting downward pressure on stock prices. Reduced liquidity can lead to higher volatility as markets adjust to the tightening monetary conditions. Investors may become more risk-averse, leading to larger price swings. Second, rising interest rates. QT can lead to higher interest rates as the supply of money decreases. Higher rates increase borrowing costs for companies and consumers, which can slow economic growth. Companies face higher expenses due to increased interest payments on debt. This can squeeze profit margins, potentially leading to lower stock valuations. As bond yields rise, fixed income investments become more attractive relative to stocks. Investors may shift their portfolios from equities to bonds, causing stock prices to fall. Third, strengthening of the US dollar reduced money supply can lead to a stronger US dollar. While this can be positive for importers, it can negatively affect multinational companies that rely on exports as their goods become more expensive abroad. A stronger dollar can reduce the overseas earnings of US companies when converted back to dollars, potentially lowering overall corporate earnings and stock prices. Finally, decreased risk appetite. QT can lead to a more cautious investment environment. Investors may become less willing to invest in riskier assets like stocks, especially high-growth or speculative sectors. Higher interest rates increase the discount rate used in stock valuation models, which can lead to lower present values of future cash flows and thus lower stock prices. Historical examples of QT and market impact. In 2017, the Federal Reserve initiated quantitative tightening after several rounds of quantitative easing in response to the 2008 financial crisis. By October 2017, the Fed began reducing its $4.5 trillion balance sheet. They set caps on the amounts by which holdings of Treasury and MBS securities would be reduced each month, allowing a certain amount of securities to roll off without reinvestment. During 2018, the stock market experienced increased volatility, with significant corrections in February and a sharp decline in the fourth quarter. Long-term interest rates rose during this period, contributing to higher borrowing costs. Concerns grew that QT, combined with interest rate hikes, was tightening financial conditions too quickly, potentially slowing economic growth. In response to market volatility and slowing economic indicators, the Fed halted QT in August 2019 and began lowering interest rates, which helped stabilize the markets. Mechanisms through which QT affects different market sectors. In the financial sector, higher interest rates can improve banks' net interest margins initially. However, if economic growth slows significantly, loan demand may decrease and default rates may rise. In the real estate sector, increased mortgage rates can reduce housing demand, impacting homebuilder stocks and related industries. For technology and growth stocks, these are particularly sensitive to changes in interest rates due to their reliance on future earnings. Higher discount rates can significantly reduce the present value of expected future cash flows. In the consumer discretionary sector, higher borrowing costs and decreased consumer confidence can lead to reduced spending on non-essential goods and services, impacting companies in this sector. Investor strategies during QT. One strategy is portfolio rebalancing. Investors may rotate into sectors like consumer staples, utilities, and healthcare, which are less sensitive to economic cycles. As bond yields rise, fixed income securities become more attractive, so increasing bond holdings is another approach. Focusing on quality is also key. Companies with low debt levels and strong cash flows are better positioned to weather tighter financial conditions. Dividend-paying stocks may become more appealing as investors seek income. Lastly, international diversification is worth considering. A stronger US dollar and higher US interest rates can lead to capital outflows from emerging markets, potentially creating investment opportunities or risks. Potential risks and considerations: over-tightening, economic slowdown. If the Fed tightens monetary policy too quickly, it could lead to a significant slowdown or even a recession, negatively impacting the stock market. Market misinterpretation. Markets may overreact to QT announcements, leading to excessive volatility. Communication from the Fed. Forward guidance. Clear communication from the Fed can help mitigate market uncertainty. Unexpected changes in policy can increase volatility. Conclusion: quantitative tightening is a powerful monetary policy tool that reduces liquidity in the financial system. By decreasing its balance sheet, the Federal Reserve can influence interest rates, investor behavior, and overall economic activity. QT often leads to higher interest rates and reduced liquidity, which can negatively impact the stock market by decreasing corporate profits due to higher borrowing costs, reducing investor appetite for riskier assets like stocks, shifting investments from equities to fixed income securities as yields become more attractive. Investors need to be aware of the implications of QT and adjust their investment strategies accordingly, focusing on risk management, diversification, and monitoring of economic indicators and Fed communications. Key takeaways. QT is the process of reducing the Fed's balance sheet, effectively tightening monetary policy. It leads to reduced liquidity and higher interest rates, which can negatively impact the stock market. Sectors sensitive to interest rates, like technology and real estate, may be more affected. Investors often shift to defensive stocks and increase bond holdings during QT periods. Clear communication from the Fed can help manage market expectations and reduce volatility. Understanding the mechanisms and effects of quantitative tightening can help investors make informed decisions and navigate the challenges posed by a tightening monetary environment. Spotting the signs of quantitative tightening before it happens can help traders position themselves to capitalize on its potential effects. QT, where the Federal Reserve reduces its balance sheet and liquidity in the financial system, typically comes after periods of economic growth or inflationary pressure. Here are the key signs to watch for to anticipate QT and strategies to capitalize on it. Economic signals indicating the need for tightening. Rising inflation. Core inflation trends. When inflation, especially core inflation, excluding food and energy, is persistently above the Federal Reserve's target, typically 2%. It suggests the Fed may consider tightening measures to cool off inflation. Wage growth. Rising wages can fuel inflationary pressure as businesses pass on higher labor costs to consumers. If wage growth accelerates, the Fed may turn to quantitative tightening to moderate economic activity. Commodity prices. Sustained increases in commodity prices like oil, metals, and food can contribute to inflation. If inflation from these inputs rises sharply, quantitative tightening may be on the horizon. Strong economic growth. GDP growth. If the economy is growing strongly and showing signs of overheating, the Fed may step in with quantitative tightening to cool the economy and prevent runaway inflation. Job market tightness. Low unemployment and strong labor markets increase the risk of inflationary pressures. A tight labor market may prompt the Fed to consider tightening measures. Consumer spending and confidence. When consumer spending is high and consumer confidence is at elevated levels, the Fed might worry about an overheating economy and signal potential quantitative tightening. Federal Reserve communications, Fed speeches and statements. Hints in Fed speeches. Look for signals in public speeches from Federal Reserve officials, especially the chair and voting members of the Federal Open Market Committee, or FOMC, if they express concerns about inflation being too high, the economy overheating, or asset bubbles. These may be precursors to quantitative tightening. Terms to watch. Key phrases such as normalizing the balance sheet, unwinding monetary stimulus, or tapering asset purchases are indicators that quantitative tightening is being discussed. FOMC meeting minutes. Shift in tone. The minutes of FOMC meetings often provide detailed insights into policymakers' discussions. If there's talk of reducing the balance sheet or concerns about excess liquidity in the system, this could signal upcoming quantitative tightening. Bond market signals. Rising yields on long-term bonds. Bond yield increases. If bond yields, particularly long-term U.S. Treasuries, like 10-year or 30-year, begin rising steadily, it may indicate that the market is anticipating quantitative tightening. As the Fed reduces its balance sheet, it can push long-term interest rates higher due to decreased demand for bonds. Yield curve steepening. As quantitative tightening becomes likely, the yield curve, which is the difference between short-term and long-term interest rates, may steepen. A steepening yield curve signals expectations of tighter monetary policy in the future, decreasing demand for U.S. Treasuries. Bond market sell-offs. If investors expect quantitative tightening, they may sell off bonds in anticipation of the Fed reducing its purchases or selling assets. A significant sell-off in U.S. Treasuries could indicate that market participants are positioning themselves for quantitative tightening, pushing bond yields higher. Stock market behavior. Stocks often react sharply to hints of tightening monetary policy. If markets experience pullbacks or increased volatility following Fed statements about reducing the balance sheet or tightening monetary conditions, it may suggest traders are bracing for quantitative tightening. Growth stocks, particularly in the technology sector, are sensitive to rising interest rates. If growth stocks start underperforming or show signs of weakness, it may indicate that investors expect tighter financial conditions and QT. Shift toward defensive sectors. If investors start rotating out of high growth or riskier sectors, like technology, and into defensive sectors, such as utilities, consumer staples, and healthcare, it could be a sign that the market is preparing for a tightening monetary environment. Reduce bank lending. When credit conditions tighten and banks become more conservative with lending, it could signal that liquidity is drying up. The Fed may implement QT to further reduce excess liquidity in the system. Widening credit spreads. A widening spread between corporate bond yields and U.S. Treasury yields often signals increased risk aversion. This can indicate that investors expect monetary tightening, as QT can lead to higher borrowing costs for corporations. Inflation expectations in the market. Inflation break-even rates. Break-even rates are derived from the difference between Treasury inflation-protected securities, or TIPS, and regular Treasury bonds. Rising break-even rates indicate that investors expect higher inflation. If break-evens are trending higher, it suggests that the Fed may intervene with quantitative tightening to keep inflation in check. Market-based indicators of Fed policy expectations. Fed funds futures. Futures markets often price in expectations for Federal Reserve policy changes. If Fed funds futures begin to signal rising rates or expectations of balance sheet reduction, it indicates that market participants are expecting quantitative tightening. Overnight repo market. The overnight repurchase agreement, or repo market, is a key liquidity gauge. If stress appears in the repo market, such as rising repo rates, it may indicate that liquidity is drying up. This could either be a precursor to or a reaction to quantitative tightening. How to capitalize on quantitative tightening in trading. Understanding the signs of quantitative tightening can allow traders to position themselves in a way that benefits from its impact on various financial markets. Here are some strategies to capitalize on quantitative tightening. 1. Shift toward defensive stocks. Defensive sectors. As quantitative tightening leads to reduced liquidity and higher interest rates, growth stocks may suffer, while defensive sectors such as utilities, consumer staples, and healthcare tend to perform better. These companies are less sensitive to economic cycles and tend to have stable cash flows. Dividend stocks. High-quality dividend-paying stocks are likely to become more attractive as market volatility increases and yields rise. 2. Rotate into value stocks. Value over growth. Rising interest rates can reduce the future cash flows of growth companies, negatively impacting their valuations. Value stocks, which trade at lower price-to-earnings ratios and generate strong cash flows in the present, may outperform growth stocks during quantitative tightening periods. Focus on companies with strong balance sheets. Companies with low debt and strong cash flows are better positioned to weather tightening financial conditions. These stocks often outperform in a quantitative tightening environment. 3. Bond market strategies. Shorter duration bonds. As quantitative tightening typically pushes long-term bond yields higher, bond prices fall. Traders may reduce exposure to long-duration bonds, which are more sensitive to interest rate changes, and favor shorter duration bonds, which have less price volatility. Corporate bonds with high credit ratings. As credit spreads widen, lower-rated corporate bonds become riskier. Focus on higher-rated bonds that are more likely to hold value in a rising rate environment. 4. Watch for opportunities in currency markets. Strengthening U.S. dollar. Quantitative tightening often leads to a stronger U.S. dollar, as higher interest rates attract foreign capital. Traders can capitalize by taking long positions in the U.S. dollar relative to other currencies. Emerging market risks. Emerging market currencies and stocks can come under pressure during quantitative tightening, as rising U.S. yields lead to capital outflows. Shorting emerging market assets or currencies can be a profitable trade in this scenario. 5. Gold and commodities. Gold's behavior. Quantitative tightening can weaken gold prices, as higher bond yields and a stronger dollar make gold less attractive. Traders may take short positions on gold during periods of quantitative tightening. Commodities. Volatility. Commodities like oil and metals can also experience price declines during quantitative tightening, as higher interest rates dampen global growth expectations and reduce demand. 6. Adjust option strategies. Use put options on high-growth stocks. Given the potential negative impact of quantitative tightening on growth stocks, traders can buy put options on high-growth companies or indices to hedge against market declines. Volatility trading. Quantitative tightening often brings increased market volatility. Traders can take advantage of this by trading volatility products, such as the VIX, or using straddle or strangle strategies to profit from expected market swings. 7. Fixed income hedging. Short U.S. Treasuries. As bond yields rise during quantitative tightening, the price of long-term U.S. Treasury bonds will fall. Traders can profit by shorting Treasury bonds or using inverse Treasury ETFs, which move in the opposite direction of bond prices. Tips: investments. Treasury inflation-protected securities, or TIPS, can be a safer alternative during tightening periods, as they offer protection against rising inflation and interest rates. Conclusion: anticipating quantitative tightening can provide valuable opportunities for traders to capitalize on changes in market conditions. Key indicators like rising inflation, strong economic growth, and signals from the Fed, combined with shifts in bond yields, stock market behavior, and liquidity conditions, are all early signs of quantitative tightening.